So, today we're going to dig into something kind of strange that's been happening in the stock market. And we're going to do it by looking at one of the biggest companies in the world, NVIDIA. We'll unpack why their absolutely incredible success didn't quite lead to the stock explosion everyone was expecting, and what that tells us about a much bigger shift that's happening right under our noses.
And this, right here, is the central puzzle. I mean, think about it. When a company reports just mind-blowing results, you'd expect the stock to go to the moon, right? But with NVIDIA, that's not exactly what went down, and it left a lot of people scratching their heads.
To really get how massive this news was, just look at this number, $57 billion in revenue. That is an absolutely staggering figure. The kind of number that should, by all accounts, send a stock soaring.
And get this, it wasn't just the raw number. That revenue meant they grew by nearly 62% year over year. For a company that big, that kind of growth is almost unheard of. It was all thanks to this insatiable demand for their AI chips. I mean, on paper, you couldn't have drawn up a more perfect quarter.
So the expectation was simple, a skyrocketing stock. The reality, though, it was more like a collective, cautious shrug from the market. Instead of this huge celebration, a lot of investors actually started taking profits. And that disconnect, that gap between expectation and reality, is the real clue to what's going on.
So, why the cold shoulder? What gives? Well, the answer is a powerful force that's always at play in the market. It's called sector rotation. Let's break down exactly what that means, because it's the key to this whole puzzle.
Okay, so in the simplest terms, sector rotation is just big money on the move. Investors aren't necessarily selling everything and running for the hills. No, they're just shifting their cash from one part of the economy to another. They're rebalancing, looking for the next big thing, usually because they feel a change in the economic winds.
For years now, the market has looked a whole lot like this chart. Technology has been the star of the show, the biggest slice of the pie. It's sucked in a ton of investment and, let's be honest, it has driven most of the market's growth. For many, tech was the only story that mattered.
And this is what that rotation looks like in action. See that? The tech slice doesn't disappear, not at all. But it does get a little smaller as that money flows into other areas like healthcare, financials, or even energy. The market is basically just spreading the love around.
And listen, this isn't just some wild theory. Major outlets like Barron's are all over it. And they're pointing out that this can actually be a good thing. It's a sign of a healthy market, one that isn't just relying on a single engine to power it forward.
All right, so if money's shifting away from the big tech giants, where's it actually going? Let's walk through 5 sectors that tend to be the usual suspects when this kind of rotation happens.
First up, you've got healthcare. Think of a company like Johnson & Johnson. When things feel a little uncertain, investors flock to what they call defensive growth. These are companies whose products we need no matter what the economy's doing. They offer stability, which is pretty attractive.
Next, let's talk utilities. Companies like NextEra Energy become a safe harbor when those high-flying growth stocks start to sputter. They provide the electricity and water we all need, which means stable cash flow. And a lot of them are now involved in long-term trends like renewable energy, which is a nice bonus.
Financials are another classic destination. When investors start to think tech stocks have gotten a little too expensive, they often turn to big banks like JP Chase. These guys tend to do really well when the overall economy is on solid footing.
So what about the sectors that have kind of been ignored for years? Well, that's where energy comes into the picture. If there are worries that inflation might stick around, energy stocks can act as a good hedge. It's a classic case of money flowing back to a long-neglected corner of the market.
And finally, we have consumer staples. We're talking about companies like Procter & Gamble. Think about it. You're still going to buy toothpaste, soap, and diapers, right? No matter what. That creates super stable demand and gives these companies power over their pricing, making them a safe bet compared to more speculative names.
Okay, so we've seen what rotation is and where the money might be flowing. But now for the important part. How should an investor actually think about all this? Let's lay out a really simple playbook. First off, you gotta watch for the signals. The weird reaction to NVIDIA's earnings, that was a huge one. Second, it pays to monitor fund flows. Basically, follow the money and see where the big institutions are placing their bets. And third, and this one's huge, be patient. This isn't a switch that gets flipped overnight. It's more like a slow tide turning.
When you boil it all down, it's a classic trade-off. High-growth tech stocks offer that lottery ticket potential for huge upside, but they come with a lot more risk if things go south. These other rotation stocks, well, they might offer more modest gains, but they also come with potentially less risk of a big drop.
Now we have to be realistic here. The tech boom could absolutely reignite tomorrow. And this rotation thing, it's almost never a smooth, straight line. Every single sector has its own unique set of risks. And please remember, just because something is called defensive does not mean it is risk-free. Nothing is.
Which brings us all the way back to the big, looming question. Is the tech party finally over? The short answer is no. Tech isn't dead, not by a long shot. This isn't about the end of tech. It's about the market growing up. It's about other sectors finally joining the party, which can actually lead to a much broader and healthier market for everyone.
So really, the biggest takeaway here is balance. The strategy isn't to just dump all your tech stocks. It's about adding some resilience to your portfolio with the kind of stability and value you can find in other parts of the market. It's all about being ready for a more complex future.
And that really leaves us with one final question to chew on. As you watch the market change and evolve, it's worth asking yourself, is my portfolio built to ride just one single wave, or is it diversified and balanced enough to be ready for whatever the next chapter holds?